I want to check on these oil prices because this plunge is remarkable, folks. It was on reports that Saudi Arabia slashing prices and increasing supply. This after talks with Russia collapsed. Crude prices down more than 22% earlier today, the biggest loss since the launch of the Gulf War back in 1991. With me now, founder and editor of the Shork Report, Stephen Shork. Stephen, thanks for joining us.
Sure. Great to be here, Charles.
Well, it's great to have you. You are undoubtedly one of the best when it comes to this, particularly connecting the dots, because that's what I'm having a hard time with, connecting the dots. Oil goes down precipitously and everything else collapses too. Why?
Well, this all is the catalyst happens to be that Saudi Arabia did initiate a price war with the Russians over the weekend by cutting their official selling price. But let's keep in mind, this price action has very little to do with Saudi Arabia per se. This is payback from Russia. Charles, remember 2 weeks ago, the Trump administration slapped the trading arm of Russia's largest oil company, Rosneft, for its dealings with Venezuela. The fallout from those sanctions are going to mean that Russia, or Rosneft, is going to lose market share for its crude oil exports to Asia, European, and, of course, U.S. buyers. At the same time, the United States has been a net exporter of oil, crude oil, and product since October, 150,000 barrels a day. In last week's EIA report, U.S. crude oil production hit an all-time high of 13.1 million barrels a day. Those new exports of the U.S. burgeoning market are going to take market share away from Rosneft. So Russia's decision not to back an oil production cut with Saudi Arabia had less to do with Saudi Arabia and more to do as a response to these sanctions to its largest oil trading company. So this is an absolute price war.
But, Stephen, the rationale, you got to go back to the Second Punic War to find a similar rationale. I mean, what the heck is going on here? Are there any winners?
No, there is not. I mean, you know, there might be that sugar high, the consumer paying extremely low price for energy, for their energy. But this is a Potemkin village. This is not a good thing. Low oil prices, low industrial commodity prices do not drive economic growth, Charles. Economic growth drives commodity prices. And what we did see coming into this was an already decrease in energy demand because the industrial side of the U.S. economy, the industrial side of the European economy, the industrial side of the Asian economy have been in recession now for at least the last 3 to 6 months. So we've already seen that knock on to falling energy demand. Now you add in the coronavirus and you run the risk of that demand decay now transpiring into the consumer level. So this is not a good thing for anyone involved in these markets.
But is this also a wake-up call or some sort of epiphany on supply? I mean, you just started this by saying we had a record amount of production. You have all these nations around the world, some that were offline coming online. You know, aren't there limits to this, to the amount of supply, no matter how great an economy is?
There are the limits to supply, but we're in a major pivot in the world oil markets because, of course, we have substitutes in the market. This isn't all an oil-driven market for transportation needs. Of course, we're talking about EVs. So we are in that great pivot, but at this point, we simply have too much supply, not enough demand on this market. Now, fortunately, we went bearish in our report, our January 24th report, because we did start to see the telltales of the knock-on to this overhang of supply greater than demand. And heck, just last week, 5.6 million barrels at the $40 strike put traded. So clearly the market was giving us a signal that it is still oversupplied, and clearly the decision by Russia and then the reaction by Saudi Arabia signals that we're going to be looking at lower oil prices for a much longer time than most people, I think, can appreciate.
Is it too early to try to figure out how long this lasts? You know, at some point, I'm not sure how they do it, but Saudi Arabia and Russia probably have to figure out a way to come back to the table and turn this around?
I think it's Saudi Arabia, Russia, and I think it is the United States, because I am a big believer that this is in reaction with these sanctions on Rosneft. Those sanctions are going to have to be lifted by the United States to get Russia to act. So I think this is more in the U.S.'s court than it is in Saudi Arabia's court. As far as the longevity, Well, that's going to be a geopolitical concern. As far as price reaction, the models that we were running and that we've been reporting, we had the downside of $36 to $34 a barrel. Of course, we overshot that $27 low, a peak to trough decline day over day of 41%. We didn't see it to that extent, but we have retraced, but we are now in the bottom range.
Right.
So we can hold prices at these levels.
All right, Stephen, thank you very, very much. Always appreciate it. For more on these plunging oil prices, I want to bring back Aaron and Jeff. Jeff, listen, Stephen is great, and he tied in the whole geopolitical aspect to this, even bringing in the U.S. part. So who knows what's going on behind the scenes. But certainly, it does come back to this dynamic of supply and demand, and then the geopolitical aspects that always trigger shocks. Now, normally, it's an upside price shock that historically have triggered recessions in this country. I've never heard of a downside supply shock in oil triggering a recession.
I absolutely agree with that. I see nothing on the horizon telling me that this country's... I've been having people, even on your show, for 3 years telling me we're going into a recession. And they've been telling me earnings aren't going to come in up to expectations. And they've been dead wrong. I think they're dead wrong here. I would comment that crude oil over time typically tracks its incremental cost of production. And the incremental cost of production is higher than $32 a barrel.
Yeah, I mean, he did bring up EVs, too, which I thought was intriguing. The idea that we're going to go to a world, it's so weird with this coronavirus, it feels like it fast-forwarded us. Like this world where we're talking about work-life balance, where people don't go into the office, this world where we do more things online, this world where we don't use as much energy. Like, this is a world promised to us that's supposed to be amazing. Well, we're living it today and it don't feel so good.
I think, one, I think there are definitely opportunities for new technologies to take advantage of this fear, and that might help certain companies. But overall, yeah, and to Jeff's point, we did see a slowdown in industrial production, and we knew that because out of China, we knew that they were slowing down. But again, this sell-off seems like a massive overreaction. It is a price war, and so the drop in oil prices is an overreaction, and then the reaction again with the stock market again is another overreaction. And so I just see that there were certainly reasons for some concerns. The world economically is never going to be perfect. There are always going to be areas of concerns.
Right.
But I think overall we're still very strong in the U.S., and I just see a lot of this sell-off as being an overreaction to fear, and it changes in how we have to behave.
Jeff, two themes I had last week was one, retesting the March 28th low, which we didn't do last week. We obviously did today. And the notion that the individual investor is still too optimistic. In fact, the American Association of Individual Investors saw bullishness climb 8 percentage points in a single week. Are you in that camp that the back of the average investor has to be completely shattered? Their dreams and hopes about making money in the stock market have to be erased. They have to say, no mas, throw in the towel, and that's your buy signal.
I go out, Charles, and do seminars for 400, 500, 600 individuals. I just did one over at the Traders Expo in Brooklyn. And the individual investors I see are not optimistic. They're not just cautious, they're scared to death. And I would note that in the long run in business school, they teach you it's all about earnings. But I can tell you, after 56 years of looking at markets and 50 years in this business, that in the short run, the stock market is fear, hope, and greed, only loosely connected to the business cycle, because people don't follow the main tenet in Ben Graham's book, The Intelligent Investor, which says the essence of portfolio management is the management of risks, and people do not manage risk.
And speaking of Benjamin Graham, I thought 2 weeks ago Warren Buffett had a great letter talking about retained earnings, just the idea of owning companies, great companies that will come back. I mean, I think we start to look at stock price and share price, and instead of looking at the idea of the notion, Aaron, that we own a business. Do you think Apple is an amazing business? Do you wish you owned it 3 Thursdays ago at an all-time high? The answer is probably yes.
Yeah, and I agree. And we still see even within the markets, even today, that there's this mispricing of growth versus value stocks, and just some of these value stocks are really great companies that just deliver earnings year after year very consistently. They just may not be able to deliver those incredible boom numbers like an Amazon or a Netflix, let's say. So I think there's still a lot of value in the market. I think overall we're still looking at 5% our earnings growth for this year, even with the massive.
So even you're still looking at positive earnings growth for the year?
We're still looking for, in fact, so far, even with all of Wall Street's most recent revisions, we're only looking at a potential contraction in the first quarter and still positive earnings growth for the rest of the year.
Jeff?
I absolutely agree with that. But we did lower our earnings estimate from 177 to 173 because of what's going on. But we figure fair market multiple was 20 to 21 times earnings given the interest rate environment, and that gives you anywhere between a 3,400 and 3,600 price.
That's very bullish. I mean, compared to the rest of Wall Street right now.
Yeah, well, bear in mind, we put out a sell signal in mid-January.
Sure. I mean, but, so you're calling it, almost minute to minute, but by the same token, you must see a major rebound in the things that are being postponed now. In other words, the second quarter is the big question mark, I think.
Yeah, I agree.
But third, fourth quarter, you're saying some of the things that were postponed in the second quarter, people will pick them back up later in the year.
Absolutely. The consumer's in good shape. The economy, I mean, I was around, in restaurants here in New York City the past 3 or 4 days. People are still out spending money.
Yeah, I still can't get a reservation.
What? Did you tell him Jeff? I mean, come on now. Aaron, Jeff, thank you both very much. That was fantastic. We covered a lot, and you guys are spot on. I appreciate it.
Always a pleasure, Charles.
Same. Thanks, Aaron.